In 18 months, the American economy lost 8 million jobs. Not gradually. 8 million jobs in 18 months. Factories shut, banks vanished overnight, and retirement accounts built over 3 decades were cut in half before most people understood what was happening. The 2008 financial crisis has been called the worst economic collapse since the Great Depression. It has been studied, filmed, and debated for nearly 2 decades. Books were written, hearings were held, bonuses were clawed back, or so we were told. And yet the question that most explanations never fully answer is not how it fell, but how it was built. Because what happened in 2008 was not an accident of irresponsible borrowers or bad timing. It was the result of a system specifically designed to move risk without eliminating it, and that at some point stopped pretending to care about the difference. This video is not about the crash. It is about the architecture behind it, and about the reason that architecture is still largely in place today. The story of 2008 does not begin in 2008. It begins in 1999 with a piece of legislation that most Americans had never heard of and that almost no one outside of Wall Street was paying close attention to. In November of that year, President Bill Clinton signed the Gramm-Leach-Bliley Act into law. That name means nothing to most people. What it did, however, changed the structure of American finance in ways that would take nearly a decade to fully detonate. The Gramm-Leach-Bliley Act effectively repealed the Glass-Steagall Act of 1933, a Depression-era law that had spent 66 years keeping commercial banks and investment banks legally separated from each other. Under Glass-Steagall, a bank that held your savings account could not simultaneously gamble those deposits on securities markets. The firewall was explicit, legally enforced, and deliberately boring. Boring was the point. It had been designed in the wreckage of the Great Depression by people who understood, from direct experience, what happened when the same institutions that held ordinary deposits were also running speculative trading desks. The argument for repeal in the late 1990s was straightforward. American banks were losing ground to European competitors who faced no such restrictions. Financial institutions needed room to grow, to innovate, to compete on a global stage. The language used was modernization. The bill passed the Senate 90-8. It passed the House 362-57, and it was signed into law with broad bipartisan support, which is worth noting not because blame is the point, but because it tells you how complete the consensus was at the time. Almost no one in Washington believed this was a mistake. Alan Greenspan, then chairman of the Federal Reserve, supported it. Robert Rubin, the Treasury Secretary, supported it. The financial press largely celebrated it. What the repeal actually did was allow commercial banks, institutions with access to federally insured deposits and the Federal Reserve's emergency lending facilities, to acquire or merge with investment banks and securities firms. J.P. Morgan could now own an investment arm. Citigroup, which had technically already merged with Travelers Group in anticipation of the repeal, was suddenly fully legal. The firewall was gone. And what followed was not immediate chaos. What followed was a decade of extraordinary financial creativity, which is one polite way to describe it. The more technically accurate description came later, in congressional testimony, in civil settlements, and in a small number of criminal proceedings that produced surprisingly few convictions. What the repeal did, structurally, was enable the creation of institutions so large and so interconnected that their failure would become, in the language that would define 2008, unthinkable. Too big to fail was not a policy position in 1999. It was a consequence that no one had formally mapped. The map was being drawn elsewhere, in the structured finance divisions of those same newly merged institutions, where a specific instrument was quietly becoming the load-bearing wall of global credit markets. That instrument was the collateralized debt obligation, the CDO. And the reason it spread so rapidly, the reason it became the architecture of trillions of dollars in transactions across every major financial center in the world, had everything to do with 3 letters that would later become the most consequential stamp of approval in the history of modern finance: AAA. A AAA rating assigned by one of 3 major credit rating agencies Moody's, Standard & Poor's, or Fitch, meant that a security was considered as safe as United States government debt. It meant pension funds could legally buy it. It meant insurance companies could hold it on their balance sheets. It meant that capital, which, by regulatory requirement, could only be placed in the safest possible instruments, could now flow directly into bundles of American mortgage debt, repackaged, restructured, and stamped with a seal of approval that most of the institutions buying them did not fully understand, and some of the institutions selling them understood far too well. The question almost no one was asking loudly in the early 2000s was the obvious one. Who exactly was deciding which instruments deserved that AAA rating, and who was paying them to make that call? The answer to that question was not hidden. It was in the business model. The three major credit rating agencies, Moody's, Standard & Poor's, and Fitch, operated under what the industry called the issuer pays model. The bank that created the security paid the rating agency to rate it, not after the rating was assigned, before. The bank would approach the agency, describe the structure of the instrument it intended to sell, and the agency would tell the bank, informally, before any formal process began, what that structure would likely receive as a rating. If the bank wanted a AAA, and the initial feedback suggested the structure would only receive a AA, the bank would adjust the structure. Then come back, then adjust again. The formal rating, when it eventually arrived, was less a neutral assessment and more the conclusion of a negotiation that had already taken place. This arrangement was not illegal. It was disclosed in the way that things are disclosed in finance, buried in documents that no one outside the transaction read carefully, described in language that assumed a level of technical knowledge that most buyers of the final securities did not possess. And it was enormously profitable for everyone involved in the early stages of the process. To understand why, you have to understand what a CDO actually was, and why its construction created what appeared, on paper, to be something genuinely remarkable. A collateralized debt obligation is, at its most basic, a pool of debt obligations bundled together and sold to investors in slices. Those slices are called tranches, from the French word for slice, and they vary in seniority. The senior tranches get paid first when the underlying borrowers make their payments. The junior tranches get paid last. In exchange for accepting that lower position in the payment queue, junior tranche investors receive a higher yield, a higher return, to compensate for the additional risk they are taking on. This structure had a logic to it. If the underlying pool of mortgages contained, say, 10,000 individual loans, the argument went that even if some percentage of those loans defaulted, the losses would be absorbed by the junior tranches before they ever reached the senior ones. Diversification across thousands of borrowers, the models argued, made catastrophic loss in the senior tranches statistically improbable. This was the intellectual foundation on which the AAA rating was built. The models that the rating agencies used to evaluate these structures were based on historical mortgage default data drawn primarily from a period when American housing prices had never, on a national basis, declined significantly in a single year. The models were not designed to answer the question of what would happen if housing prices fell simultaneously across the entire country. That scenario, the modelers argued at the time, was not a realistic input. It had never happened. This was accurate, in the narrow historical sense that the data supported. What it missed, what the entire architecture of the CDO market was structurally incentivized to miss, was that the conditions producing the underlying mortgages had fundamentally changed. The loans being packaged into these securities in 2004 and 2005 and 2006 were not the same kind of loans that had populated the historical default data. They were increasingly loans made to borrowers with limited income documentation, adjustable interest rates that would reset significantly higher after an initial period, and loan-to-value ratios that assumed continued appreciation in the underlying property. The industry had names for some of these products. Ninja loans, no income, no job, no assets. Liar loans, because the income figures on the applications were frequently unverified and frequently wrong. The people originating these loans, the mortgage brokers and regional lenders at the front end of the chain, were paid on volume, They were paid when the loan closed. What happened to the loan after it closed was, in the most direct sense possible, not their problem. Because the loan would be sold, packaged, tranched, rated, and resold to a pension fund in Norway, or a municipal government in France, or an insurance company in Japan that had been told by a rating agency paid by the bank that structured the deal that what they were buying was as safe as a United States Treasury bond. And the question no one in that chain was asking, not the mortgage broker, not the bank, not the rating agency, not the regulator, was the simplest one of all. What exactly was in the pool? The answer, when people began to find it, was not what the models had predicted. By 2006, something was moving in the mortgage market that did not match the projections embedded in the rating agency models. Default rates on subprime mortgage pools were beginning to deviate from their historical baselines. Not dramatically, not yet, but in a direction that the instruments had been specifically structured to assume would not happen at scale. The deviation was small enough, in the beginning, to be rationalized. Mortgage markets are local, the argument went. A pocket of defaults in Ohio did not necessarily tell you anything about California. A regional downturn in construction employment did not necessarily translate to a national credit event. The models were built on correlations, on the assumption that defaults in one region of the country would not be correlated with defaults in another. Diversification, the structural premise of the entire CDO market, depended on that assumption being correct. It was not correct. What was happening in the underlying mortgage pools was a phenomenon the models had not been calibrated to capture. Correlated default risk at a national scale. The mortgages had been originated under conditions that were themselves correlated. The same relaxed underwriting standards, the same adjustable rate structures, the same dependence on continued home price appreciation, across markets that appeared geographically diverse but were economically identical in the ways that mattered. When the adjustable rates began to reset, they reset everywhere simultaneously. When home prices stopped rising, they stopped rising across the country within months of each other. The diversification that had justified the AAA ratings was, in the precise technical sense, an illusion. Not a deliberate illusion in most cases, though in some cases it was, but an illusion nonetheless, built into models fed historical data from a period that bore no meaningful resemblance to the conditions that had produced the loans now sitting inside those securities. The gap between what the system was designed to do and what it actually did was not, at its core, a gap between intention and outcome. It was a gap between what the models measured and what the underlying reality had become. The system had been designed to distribute risk, to take concentrated mortgage exposure and spread it across thousands of investors globally, reducing the impact on any single institution. What it had actually done was concentrate that risk in ways that made it invisible until it was catastrophic. The mechanism was this. When a bank originated a mortgage and sold it into a CDO pool, it transferred the credit risk of that loan off its balance sheet. That was the intended function. But then the same bank bought the AAA tranche of a different CDO, and another bank did the same. And insurance companies sold credit default swaps, essentially insurance contracts, on those same CDO tranches, collecting premiums on the assumption that AAA-rated instruments would not default. The risk had not left the system. It had been redistributed into the balance sheets of institutions that were all exposed to the same underlying correlated risk, and none of whom, by 2006, had a clear picture of how much total exposure the system as a whole was carrying. The regulators did not have that picture. The Federal Reserve did not have it. And critically, neither did most of the banks themselves. A study published later by the Federal Reserve Bank of New York found that the senior management of major financial institutions frequently did not understand the full risk profile of the structured products sitting on their own balance sheets. The instruments had become too complex for the people who owned them to accurately value them. And when you cannot value something, you cannot price the risk of losing it. What you can do, what certain institutions chose to do, is recognize that the gap between the rated value and the real value had grown wide enough to bet against. And that is where the story that most people believe about 2008 begins to come apart. The version of 2008 that most people carry is a story about excess and ignorance, about borrowers who took on mortgages they could not afford, about bankers who got carried away in a bull market, about regulators who were asleep while the system overheated. It is a story about a system that failed because the people inside it did not see what was coming. That version is not entirely wrong, but it is missing a fact that changes the moral architecture of everything that came before it. In 2006 and 2007, while the CDO market was still operating at full volume, while pension funds in Europe were still buying AAA-rated tranches, and insurance companies were still writing credit default swaps on instruments they did not fully understand, certain desks inside certain major financial institutions were doing something that does not fit the narrative of collective blindness. They were betting against the same products their own firms were selling. Goldman Sachs, which had been one of the most active underwriters of CDO products, began in late 2006 to systematically reduce its own exposure to the mortgage market and to build what its internal documents would later describe as a significant net short position, a bet that the value of mortgage-backed securities would fall. The scale of that position, by the time the crisis broke, was approximately $10 billion. $10 billion placed against instruments that Goldman's own salespeople were simultaneously selling to clients as sound investments. This was not a secret within Goldman. It was a deliberate strategic decision, documented in internal emails that would later become exhibits in a Senate investigation. In one of those emails, a senior executive described certain mortgage products the firm had sold to clients using a term that was direct enough that it required no translation when it was read into the congressional record. The firm collected fees for structuring and selling products it internally assessed as likely to fail. The Senate Permanent Subcommittee on Investigations spent 2 years examining this. Its 2011 report ran to 640 pages. Goldman was not alone. Deutsche Bank's top CDO trader built a similar short position, documented in internal communications that described the underlying mortgage pools in terms that were incompatible with the AAA ratings those pools had received. Merrill Lynch and Citigroup held billions in CDO exposure on their own balance sheets, not because they believed in the product, according to later testimony, but because the fee income from continuing to structure deals was too significant to stop the machine voluntarily. The midpoint of this story is not the crash. The midpoint is the recognition that the crash was anticipated, specifically, precisely, and profitably, by at least some of the institutions that had built the system in the first place. This reframes everything that came before it. The relaxed underwriting standards were not simply a failure of oversight. The rating agency negotiations were not simply a flawed methodology. The global distribution of risk into instruments that could not be accurately valued was not simply a failure of models. Each of those elements, viewed through the lens of the short positions being built in 2006, looks less like a system that broke and more like a system that was useful precisely because others believed in it longer than the people at its center did. That does not mean 2008 was a conspiracy in the dramatic sense. The legal standard for fraud is specific and difficult to meet, as the relatively small number of criminal convictions from the crisis demonstrated. But it does mean that the story of collective blindness, of a system that nobody understood and nobody could have stopped, is not the full story. Some people understood it well enough to profit from its failure. And the question that the second half of this video is going to examine is simpler and more uncomfortable than any of the technical ones. What did the people who were supposed to stop this actually know, and when did they know it? The Federal Reserve had been watching the mortgage market with increasing unease since at least mid-2006. In March 2007, a full 18 months before the system broke openly, Ben Bernanke told Congress that the problems in the subprime market appeared to be contained. That word would later become one of the most analyzed in the history of American financial regulation. Not because Bernanke was uniquely uninformed, the data available to the Fed at that moment was genuinely ambiguous, but because it revealed the operating assumption embedded in the entire regulatory framework that the instruments designed to distribute mortgage risk had actually done so effectively, and that losses, when they came, would be spread thin enough across global markets that no single institution would be fatally exposed. The circuit breaker, in other words, was assumed to be already in place and working. That assumption was tested for the first time in June 2007, when two hedge funds managed by Bear Stearns, both heavily invested in CDO products, collapsed within weeks of each other. Bear Stearns initially moved to bail out one of the funds with its own capital, then abandoned the effort when the scale of the losses became clear. The funds were liquidated. The broader market absorbed the news with a sharp but brief decline and then stabilized, which reinforced the containment thesis. If two heavily leveraged CDO funds could collapse without bringing down the broader system, perhaps the distribution of risk had worked roughly as intended. The models, the argument went, had held through a real stress event. That was the reading. It was wrong. What the Bear Stearns fund collapse revealed, to those paying close enough attention, and there were not many, was that the instruments inside those funds could not be accurately valued when the market for them began to thin. When the funds had to sell positions to meet redemption requests, there were no buyers at anything close to the modeled price. The bid-ask spread on some tranches was not a few percentage points. It was the difference between a modeled value and zero. The market for these instruments was not illiquid in the ordinary sense of that word. It was, in the technical language that would become universal by late 2008, broken. And a market that is broken in a hedge fund in June 2007 is the same broken market that will surface in a balance sheet 15 months later. It does not repair itself between appearances. By early 2008, the stress had migrated from the fund level to the institutional level. Bear Stearns itself, the fifth largest investment bank in the United States, with assets of approximately $395 billion, was experiencing something that had no clean historical precedent in modern finance. Not a retail bank run with depositors lining up outside branches, but a wholesale institutional run, counterparties refusing to roll over short-term lending agreements, prime brokerage clients pulling their assets, and the overnight repo market, the short-term mechanism that major financial institutions depended on for daily liquidity, beginning to price Bear Stearns paper at a significant discount to its stated value. On March 10, 2008, Bear Stearns publicly stated that its liquidity position was strong. On March 13, it informed the Federal Reserve that it would be unable to open for business the following Monday. 72 hours separated those two statements. The Federal Reserve, working through J.P. Morgan Chase, arranged an emergency acquisition over a single weekend. By Sunday, March 16, Bear Stearns had been sold to J.P. Morgan for $2 per share, a price later revised to $10, with the Federal Reserve agreeing to absorb up to $30 billion in Bear Stearns losses to make the deal viable. The broader market stabilized, and that stabilization produced a conclusion that several key decision-makers would carry directly into the autumn of 2008, that the system had a functional circuit breaker, and that the willingness to activate it, to step in with public funds to prevent a disorderly failure, had been demonstrated. That conclusion was reasonable. It was also, in one specific and consequential respect, incomplete. The institution that would test it 6 months later was larger, more interconnected, and the decision that would be made about it would not be the same. On September 12, 2008, the most senior officials of the United States Treasury and the Federal Reserve gathered in Lower Manhattan to do for Lehman Brothers what had been done for Bear Stearns 6 months earlier, to find a buyer, broker a deal, and prevent a disorderly failure that no one was certain the system could absorb. By Sunday, September 14th, the effort had collapsed. Barclays had withdrawn. Bank of America had redirected its attention to Merrill Lynch, and the decision that Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke made, or arrived at by the absence of any workable alternative, was that Lehman Brothers would not be saved. On September 15, 2008, Lehman Brothers filed for the largest corporate bankruptcy in American history, with $613 billion in debt. What followed in the next 72 hours demonstrated, with a precision that no economic model had been able to generate in advance, exactly how wrong the containment thesis had been. The commercial paper market, the short-term borrowing mechanism on which American corporations depended to fund daily operations, payroll, inventory, froze within 48 hours of the Lehman filing. A money market fund called the Reserve Primary Fund, which held Lehman commercial paper, announced that it had broken the buck, that its net asset value had fallen below $1 per share, triggering a withdrawal panic across the entire money market sector. The credit markets did not slow. They stopped. The spread between what banks charged each other to borrow overnight and the risk-free rate, The TED spread, which under normal conditions sits below 50 basis points, reached 463 basis points within weeks. That number has no intuitive meaning until you translate it into operational terms. Banks did not trust each other enough to lend at any normal price. The interbank lending market, the circulatory system of the global economy, was in cardiac arrest. 8 million jobs disappeared in 18 months. Not as a delayed consequence, as a direct transmission of the credit freeze into the real economy, where businesses that depended on short-term borrowing to operate could not access it, where auto loans and small business credit dried up within weeks, where the velocity of money contracted in ways that the models, again, had not fully specified in advance. And here is where the Chekhov's gun planted in the earliest chapters of this story detonates, not in the flames of the Lehman collapse, but in the quiet that followed it. The emergency legislation that Congress passed in October 2008, the Troubled Asset Relief Program, authorized $700 billion in public funds to stabilize the financial system. The stress tests that followed. The emergency Federal Reserve facilities, the guarantees extended to money market funds. Every one of those interventions was designed explicitly to restore confidence in instruments and institutions whose value could not be independently verified, because the mechanism that was supposed to verify it, the rating agency system, had assigned AAA ratings to instruments that were worth, in some cases, nothing. That system was not dismantled. The Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 introduced new oversight requirements, new capital buffers, new stress testing regimes. It did not change the issuer pays model at the core of the credit rating industry. The same three agencies that had rated collateralized debt obligations AAA in 2006 continued to operate under the same fundamental business model. The same structural incentive that the entity paying for the rating has an interest in the outcome of that rating remained embedded in the architecture of global credit markets. The gun, in other words, was not unloaded. It was reloaded, placed back on the wall, and the next generation of financial engineers was invited to study the room. The 2008 financial crisis is still, in the popular understanding, a story about excess, about a bull market that ran too long, about regulators who were too slow, about borrowers who reached beyond their means, and a system that rewarded them for doing so until the moment it stopped. That understanding is not false, but it is incomplete in a way that matters because incomplete diagnoses produce incomplete remedies, and incomplete remedies leave the underlying condition in place while the next cycle of identical incentives accumulates quietly in instruments that have different names and the same structural logic. What the evidence assembled over nearly 2 decades of investigation, litigation, and congressional testimony actually describes is something more specific than a system that failed because no one understood it. It describes a system that was understood, selectively, precisely, and profitably, by the people positioned to understand it most clearly, and that continued operating after that understanding had been formed because the fees generated by its continued operation were too large to voluntarily abandon. The mortgage broker who originated the loan had no incentive to verify the income figure on the application. The bank that packaged the loan into a collateralized debt obligation had no incentive to hold it on its balance sheet long enough to discover whether it would perform. The rating agency that stamped it AAA was paid by the bank requesting the rating. The regulator operating under a containment thesis had every institutional reason to hope that thesis was correct, and the institution building a $10 billion short position against the same instruments its salespeople were actively marketing to pension funds had by that point resolved any internal ambiguity about what the answer was going to be. This is not a story about villains in the dramatic sense. The legal system largely concluded that it wasn't. The number of senior financial executives who faced criminal prosecution for conduct related to the 2008 crisis is a number that can be counted without requiring both hands. It is a story about a structure of incentives so precisely misaligned that the rational behavior of each individual participant produced an outcome that was catastrophic for the system as a whole. and specifically catastrophic for the 8 million people who lost their jobs in 18 months, and the millions more who lost their homes, their retirement savings, and their capacity to borrow against a future that had quietly been pledged as collateral against instruments they had never heard of. The reason this can happen again is not that human beings are uniquely greedy or that financial markets are uniquely corrupt. It is that the structural conditions that made 2008 possible were not structurally resolved by the response to 2008. The issuer pays model at the core of the credit rating industry remains in place. The concentration of systemic risk inside institutions whose failure would require public intervention remains. The gap between the complexity of financial instruments and the capacity of any single regulator or any single institution's own risk management desk to accurately value those instruments under stress conditions remains. Dodd-Frank added perimeter fencing around a system whose core architecture was preserved intact. The distance between the rated value of a security and its real value in a broken market is not a gap that regulation has closed. It is a gap that the next cycle of financial engineering will eventually rediscover, under conditions that the current models will not have been calibrated to anticipate. The 2008 crisis was not a natural disaster. It did not arrive without warning, without mechanism, without human decisions at every stage of its construction. It was built, instrument by instrument, rating by rating, short position by short position, by people operating rationally within a structure that made catastrophe not just possible but, in retrospect, close to inevitable. The architecture is still there. And if you've made it this far with me, I want to invite you to subscribe to our channel and follow along every day. Share this video with 5 people who think 2008 is a story they already understand. Leave a comment telling me what you think the next version of this looks like, because the question is not whether the structure will be tested again. The question is whether anyone will be paying attention when it is.